TheoTrade. This is Don Kaufman. It's January 9th, 2019, and you are watching the TheoTrade evening video. First and foremost, the S&P's having a rather light trading session, and by light, I simply mean, well, the S&Ps themselves have only effectively traded about 1.4 million contracts, which, again, in comparison to much of the trade that we've seen as of late, has been, well, light in terms of volume. The range, although again we throw off a decent range of 30 points, is also well inside some of the action that we've seen on a day-to-day basis. Nevertheless, here we are on a Wednesday afternoon. What to expect kind of moving forward? One of the key points to be made with where we're currently trading inside of the S&P, for that, well, we're actually going to pull up specifically the SPX, the granddaddy of all option products. One of the first things that I want to show you inside of the SPX has to do with, of course, the remainder of movement inside of the week. Okay, we still have Thursday and Friday left in this week. Okay, and we've contracted quite considerably, but we've contracted to about a $34 expectation of risk kind of moving forward on the week. Again, I would believe, based on where we're at right now, that we're going to see every ounce of movement of that $34 or $35 as kind of depicted in the expected move for the remainder of the week. The other aspect you want to kind of be mindful of here in the SPX, and for this, I'm kind of going to zoom out for a second and kind of give you orientation on the entire week. This has everything to do with what we term the expected move. Now, for those of you that stay tuned in, turned on, the SPX expected move throughout the course of this week, okay, was just north of about $60. Now, what that effectively means is the option market depicts risk to be about $60 higher or $60 lower. Look where we actually came to today. It's, again, the middle of the week. It's Wednesday. But when you start looking at this all the way down to a 1 minute, it is absolutely uncanny, okay, how we've actually held the edge of the expected move. And a level that you can use for Thursday and Friday moving forward, that level is right there. It's just, again, around 25.92. We hit it, came right back down off of it. Now, this is not, some imaginary line just drawn across the screen. This is exactly what the option market was depicting this risk to be from all the way from last Friday moving forward. And it holds weight. Why? Because there are literally billions of dollars being traded, okay? And effectively, there is a hedging relationship that exists at the edge, of course, of this expected move. Looks like a high likelihood of us trading under 25.92, okay? Not necessarily just throughout the remainder of the week, but closing under 25.92 by the Friday expiration. With that, let's get down to kind of the meat of the discussion for this evening. And that is, we're getting a tremendous number of emails in the midst of this most recent rally. In fact, we'll actually display this. Let's go ahead and pull off the edge of the expected moves over here and take a look at where we're effectively at. And that happens to be none other than, okay, this kind of wicked bounce that we've seen most recently in the SPX. That happens to be from 23.50 all the way back to, well, we're effectively at right now, which is 25.80. Oh, I don't know. What's 300 S&P points amongst friends? I mean, effectively, we're coming off of one of the most recent high levels of 2,900 all the way down to about 2,300. So, well, all right, we lose about 600 S&P points. Okay, now we're in the midst of a decent sized bounce, getting back, okay, about 200-300 of those S&P points. At this point in time, though, okay, we believe that we have some very decisive, very definitive reasons to build, okay, yourself into still net bearish positions, long duration moving forward. And again, I want to be very clear about that. I'm going to try to provide you 3 decisive reasons to be long-term bearish. And these decisive reasons, this is not going to be, again, looking at a bounce inside of a marketplace. It's not going to be anything volatility, related. I'm going to stay very removed from whatever we interpret in terms of signals, in the marketplace. We're going to be very quantitative, in this measurement. For that, let's actually cruise over to a little bit of a PowerPoint that I put together to give you, again, these 3 so decisive reasons, to still be, again, effectively longer duration bearish on the marketplace. All right, reasoning number 1. What you happen to be looking at is from the U.S. Department of Treasury. It's their daily Treasury yield curve rates. What are you really looking at? People have talked about the yield curve pretty much ad nauseum over the last, 2018, pretty much the last year. Well, let me actually take you in here and display a little bit of this. And I've talked about this, again, kind of extensively. And what we effectively have right now, is a flattening and even an inverting of the yield curve. What does that really amount to? Again, this is as recent as it effectively gets. These are, again, trading days right here in January. And what you're looking at is interest rates in the short duration. And that's what this is, all right? Let's take a look at, like, for example, the 1 year, This is what, 1 year paper, that's 1 year Treasury paper. This is the yield, which is 2.6, again, percent. How does the 1 year compare, to, for example, the 5 year? Here's the 5 year, here's effectively the 1 year, How do these compare? Well, right now, you have the 1 year sitting at about 2.6%, the 5 year sitting at 2.5%. You go all the way out down, to the 10 year, and here's our 10 year, What do we have? 2.7. They're within, again, a stone's throw of one another. But the 1 year, is actually exceeding ever so slightly the 5 year. And this is what people are talking about when they're talking about like an inverted yield curve. And that is, again, it's short duration, yield coming above and beyond the longer duration yield. Now, what's so decisive about that? Well, in every case, of a yield curve inversion to date, that has actually led to a softer economy. This has occurred in a softer economy, and eventually led to recessions. Now, we're not quite home just yet. I mean, is it inverted? Yeah, portions of the yield curve are absolutely, unequivocally, you're looking at it, inverted at this point in time. Is it necessarily the quintessential 2 year above the 5 year? Well, the 2 year and the 5 year are absolutely identical. And in a lot of recent trading sessions, yes, the 2 year has been above. And you could see the 2 year above the 5 year. Here's the 2 year above the 5 year. And that's typically the sign, like, that's it. Moving forward from here, it's only a matter of time. Now, granted, maybe you don't necessarily believe into this too much. Maybe this is going to be the one time that this indicator does not effectively work. And I get that. And I can believe that. However, let's put this together, with a number of other, again, detailed ideas over here, because that's what this is. This is not just looking at like one indication. I wanted to give you, again, 3 decisive reasons to be long-term bearish on these markets. All right. So let's move past number 1, which is the inversion of the yield curve, or the flattening of the yield curve, which is absolutely inverted and probably will continue to do so. Next, now what you happen to be looking at is the total assets of the Federal Reserve. Effectively, what I'm saying, this is the Federal Reserve. This is their balance sheet. Now, why am I showing you the balance sheet? Well, this is the balance sheet, and it happens to be zoomed in on 1 year of time. And again, these are taken directly from, well, the previous was the Treasury site. This is the Federal Reserve, website. Anybody can go on here and just type in, Federal Reserve balance sheet, and you can kind of play around with the time frame over here. What is it? It's a chart. You know what this chart is? It's over 1 year, And this is equivalent to, it's like 4.4, That's actually 4.4, get this, trillion dollars, $4.4 trillion. What are they doing? That's a giant vacuum. What's the vacuum doing? It's pulling capital out. Now, we're not getting crazy just yet. But we have gone from 4.4 trillion. We're just right now approaching right around the $4 trillion mark. Now, everybody has got their heads wrapped around the fact that it's okay, Don. Jerome Powell says, okay, that we're probably not going to raise rates throughout 2019. Okay, well, that's fine. But my argument is this has nothing to do with rates. I don't care what rates are doing. They have a vacuum, okay, pressed into the marketplace. What's the vacuum? It's actually contracting the balance sheet. They got to get this sucker down. They got to get this balance sheet, okay, closer to what, 2, maybe 2.5 trillion before we enter into the next recession. And I don't care what they're saying on a day-to-day basis, okay, forget all the rhetoric. They have a vacuum in the marketplace, and this is exactly why the markets panicked. They absolutely panicked coming into December. Why? Because they said that they put this on autopilot, which they absolutely have. This is actually something that was put together, and this was actually put together over a year ago. This is put together by JP Morgan Asset Management, and what JP Morgan put together was the reduction, okay, of the balance sheet. And you know what the interesting irony is? We have followed this to a T. To a T. Right up here is that 4.4 trillion, okay, and we're starting again to contract the balance sheet. In fact, we're a little bit ahead of what was the forecasted reduction. This is just simply compounding our risk. Again, these are just two reasons, all right? So we looked at the Treasury, the kind of the yield curve inverting. We looked at the fact that the Federal Reserve has a gigantic vacuum on the entire economy, sucking capital out of the markets. As I said, they got to get that thing down to 2 trillion, 2.5 trillion before we enter the next recession. Otherwise, what are you? You're caught with your pants down. You're caught with your pants down if we go into a recession with a balance sheet like this, okay? And effectively, at that point, you become Japan. What's Japan? Stuck in a liquidity trap since the 1990s. Last, but definitely not least, here's another fun one, okay? Third reason that you should be decisively long-term bearish. Da bears. What is the bears? Okay, this is something that, you know what, it took some time to put together this particular slide. And I want you to spend some time looking at it with me here. Between, okay, 1900 and 2015, there's 32 bear markets, averaging one every 3.5 years. Okay, I've been waiting for more than 3.5 years. The last bear market coincided with the global financial crisis. Between October 2007 and March 2009, okay, the Dow at that point declined 54%, right? But that was kind of an outlier, right? It was a huge move, okay? Bear markets, though, since the 1930s. Now, I'm very, very careful on this one. Since the 1930s, I omitted, all right, the obviously Great Depression in there because I didn't think it was fair because it really, okay, it caused the analytics of this to be so vastly off to put in the Great Depression. So I omitted that as an outlier. You know, the largest, okay, of all the outliers, I omitted it intentionally to give you a much more definitive number. So bear markets since the 1930s have had an average duration 18 months, okay? Average loss in value of about 40%. The Nasdaq officially entered into a bear market on December 20th, 2018. The Russell officially entered into a bear market on December 17th. Okay, guess what? Clock's ticking. Clock's ticking. So now you have three decisive reasons that you better think about being long-term bearish. Does it mean this is going to last 18 months? Absolutely not. But that is the average bear market. We just kicked this thing off. Okay. In fact, the Nasdaq and the Russell are officially into bear market territory. The S&Ps, they didn't hit it. They came within like 0.2% of being declared a bear market, and they missed it. Okay, and I don't mean to be this, you know, big bearish and negative over here. When it comes right down to it, though, okay, that's what the market is effectively throwing at us from this point forward. Okay, again, three decisive reasons to be long-term bearish. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.